In a single trading session, one single company once wiped out $589 billion. That is more than the entire annual economic output of Argentina. It did not happen during a war. It did not happen during a global pandemic either. It happened in just 6 hours of regular trading. Nvidia holds the world record for the largest single-day market loss ever. Investors woke up and watched $500 billion vanish into thin air. Panic spread through Wall Street faster than wildfire. Retail traders were caught completely off guard. Leveraged positions were liquidated in minutes. Yet this was not an isolated event in financial history. Giant market collapses happen more often than you think. Understanding these historic wipes can make you a far better trader. It keeps you from buying right at the top. It protects your hard-earned cash when panic hits. So let us break down the top 5 biggest corporate wipes in history. The 5th biggest single-day loss belongs to Alphabet. Google's parent company once lost over $150 billion in one day. It happened after a new product demo went wrong. Investors panicked over artificial intelligence competition. They dumped millions of shares without hesitation. The 4th spot goes to Apple. In September 2020, Apple dropped $180 billion in 24 hours. Nothing was fundamentally broken inside Apple. Valuations had simply gotten way too high. The market snapped back to reality like a stretched rubber band. 3rd on the list is Amazon. In April 2022, Amazon lost $206 billion in one session. Their quarterly earnings report showed slowing online shopping growth. Higher operating costs squeezed their profit margins. Traders rushed for the exit doors all at once. 2nd place goes to Meta, formerly known as Facebook. In February 2022, Meta collapsed by 26% in a single day. That single drop erased $232 billion of market value. User growth had stalled for the very first time. Heavy spending on the metaverse terrified mainstream investors. And the #1 largest single-day stock loss belongs to Nvidia. In early 2025, Nvidia plummeted by nearly 17%. That wiped out $589 billion in market capitalization. Concerns arose over cheap competing artificial intelligence models. Investors suddenly questioned if massive tech spending was truly justified. These 5 moments erased over $1 trillion combined. Notice the common thread behind every single one of these crashes. Massive losses do not usually start with terrible economic news. They start when expectations outgrow reality. When stocks trade at extreme valuations, perfection is already priced in. Even a tiny rumor or minor miss can unleash total chaos. Algorithms start selling automatically when key support levels break. Retail stop losses get triggered sequentially. This creates a self-reinforcing downward spiral. Traders who do not manage risk get crushed in hours. Now let us look at what happened in the stock market today. Today saw dramatic split action across the entire market floor. Macroeconomic data took a backseat to raw stock rotation. High-flying artificial intelligence and semiconductor stocks faced heavy selling pressure. Overnight, Asian chip makers suffered sharp drops across global exchanges. Companies like SK Hynix and Samsung fell over 10%. That global wave of selling carried directly into Wall Street this morning. Micron, Advanced Micro Devices, and Applied Materials tumbled sharply during early trading. Investors are growing nervous about heavy artificial intelligence capital spending. They are questioning whether massive infrastructure costs will generate immediate profits. When big institutional money gets nervous about tech, it moves fast. But here is the most interesting part about today's price action. The broader stock market did not collapse with tech. In fact, money did not exit the stock market entirely. It rotated into traditional value and consumer defensive companies. The Dow Jones Industrial Average surged up over 600 points today. Old economy giants like Coca-Cola rallied significantly after reporting strong earnings. Financial institutions like JP Chase traded near record all-time highs. This is what professional traders call a classical sector rotation. Capital leaves high beta growth stocks and flows into steady dividend payers. If you are enjoying this actionable breakdown, hit that subscribe button right now. Subscribing ensures you never miss our daily stock market analysis and trading guides. Understanding sector rotation gives you a massive edge as an investor. When technology stocks drop, beginners usually assume the whole market is failing. Intermediate traders look deeper under the surface. They see where institutional capital is actually flowing. Today was not a market crash. It was a reallocation of risk by major funds. Smart money moved out of expensive chip stocks and into undervalued income assets. So how can you trade this market setup effectively? First, check your portfolio concentration immediately. If 80% of your money is in tech, you are exposed. Diversification protects you against sudden single-day wipes like Nvidia's. Second, pay close attention to corporate earnings announcements. Companies with real cash flow and reasonable valuations are winning right now. Speculative growth companies with zero profits are getting punished severely. Third, never trade without strict stop-loss protection. When institutional algorithms start dumping a stock, retail traders cannot stop it. Setting risk parameters beforehand prevents catastrophic portfolio damage. Always decide your maximum loss threshold before entering any new position. Fourth, keep cash reserves ready on the sidelines. Historical data shows that panic sell-offs create extraordinary buying opportunities. Nvidia, Meta, and Amazon all eventually recovered after their historic drops. Investors who bought during peak panic made incredible long-term returns. Great entry prices only appear when others are terrified. To profit in the stock market, you must separate noise from value. Daily price swings feel intense when you watch the chart minute by minute. Focus on underlying business fundamentals and valuation metrics instead. Ask yourself if a company generates real, growing revenue today. Check whether the stock is trading at a fair price-to-earnings ratio. Avoid chasing parabolic stock charts driven purely by hype. The biggest stock market losses in history all carry one crucial lesson. No company is too big or too popular to drop 20%. Risk management is what separates gamblers from successful full-time investors. Protecting your capital during downside volatility is always priority number one. Once your downside is protected, the upside takes care of itself. Keep watching market trends closely and stay disciplined with your trading rules. Be sure to check out our next educational stock market video posted daily.